trade plan made a lot of money. It made a lot of money. This last year, I did have a subscription offering and for a small fee, and I put out alerts for what I call the Commodity Accelerator trade plan. In front of you is my results, dollar for dollar of the closed trades that I took relative to the alerts that were sent out. My position sizing was roughly around probably a little under 5,000 a trade, so a risk of about 2,500 per trade. We had 11 total, counting all the rolls. So 9 wins, 2 losses for 82% win rate and a profit factor of nearly 12. Realized gains were about 55,000 on, total losses were 5,000. So 60 in the good direction, 5 in the bad. So I don't even remember the bad ones. Anyway, so if you're interested in participating in this, I'm going to walk you through in detail.
The following is presented for informational and educational purposes only. This is not investment advice. Please consult your financial advisor. Thank you.
Hey guys, this is demo video for potential trade setup on Commodity Accelerator option spread trade. We have Rio Tinto as a possible candidate here, and I'm going to show you why. But I've dialed the chart back in time a little ways to the year 2003, somewhere in the summer of 2003. So get the picture of this fractal in your mind and notice a couple things. Triangle, increasing moving averages, a high volume candle on the triangle breakout. Okay. So I'm going to hit the play button on bar replay and let you guys see. I'm going to kind of get through this pretty quick. Okay, so fast forward. This was the run. So we had roughly, what was it, roughly 4 years of consolidation, almost 4 years of consolidation, and then almost a little more than that of a bull run. So just kind of get that picture in your mind. All right. I copied the fractal there below, but let's scroll that off screen and just look here. What's our consolidation period? A little more, so it's more than a full 4 years for sure. So roughly the same time period. So here we have, this is Thursday. We have one more day left on this last candle, weekly candles. Here we have a candle that wants to print. Now we don't have the really stout breakout volume on this candle because the stock is a much more highly traded company for one thing. And we don't have as steepward as upper sloping moving average. So that's, both of those are not as attractive as the last one. Although it is a longer consolidation period, we've established a floor here around this $50 range. Strong buying support there. And we're breaking out. So based on our other commodity accelerator trades, the ones that have gone really well, we've typically taken them on this candle breakout, or we've taken them as the stock came back to the line. So that would be ideal. So let's see. Let's look at, I moved the fractal to kind of compare the two just for fun. They're slightly different, but you do have kind of a higher peak and then a longer consolidation, and then we break out. So we'll see what happens. Rio's going to trade a whole lot in lockstep with emerging markets, and if so emerging markets break out, that's possibly what you're seeing there. It's going to be in a lot of emerging market. So given that we've got the setup, let's jump into my pricing calculator for the spread. And this is the part that's a little bit of an art. So I've shopped the option chain a little bit just to kind of skip ahead for you guys. There right now there's the most liquidity past January is going to be for the March. Now, I was on here the other day and I saw a lot of liquidity in the summer. So we'll have to see when the market's open what it gives us. But here we've got about 150 days left, and on a 70-80 spread, again, the price is 70.62. It'd be really nice to kind of have that price pulled just below our long leg. But the price is 762, our spread is 70.80. We have got a few things we want to see here. I want to see a little tighter spread there. I'd like to see maybe a 330. Again, we're beating Black-Scholes. That's good. We usually do. That's a pretty nice beat of 10%. We've got lower implied vol on our long leg than the short leg. That's a good guy because that means that short leg is premium, so that's going in your pocket to offset the cost of the leverage. And a long leg is at a discount to its HV 365, so it's implied vol over 365 days. So we would expect the implied vol on the long leg, if it works in our favor, or even sideways, we would expect this implied vol to catch up and give us some additional accretion there, and then the implied vol to kind of stay the same such that we get a little bit of premium as we carry it. Okay, so just looking at theta, the difference between these two thetas are pretty tight. It's almost negligible. So your time premium, let's see, it might actually be a slight premium to carry this guy. It's very close to zero either way, so it's a non-issue. This is all about capturing a price move. So let's take a look at our trade plan. So down here in the position details, let's assume we can get it for 320. So it's printing at 330. Let's say it's 320. So I've got about a 3 to 1 risk reward on it. I've got a nice leverage on the delta. The delta is very beefy. I'm going to use a 70-50 stop and target. I would tell you most likely this guy could actually get kind of vertical on if it does what it did last time, which means we're going to be rolling the spread until we run out of steam. It doesn't have to do that. The beauty of option spreads is that you don't have to be perfect on timing. So we could just stagger sideways, and because we're at the money, we won't be paying time premiums. So that's the benefit either way. And in case we have a plan for it, so we've got a target of something like an $8 exit and a 160 exit, which is half of our entry. So for 298, it'd be nice to get it close to $3. We might try to say, put half in with the breakout candle and look for a retracement and get the other half. Probably play something like that, and that way a dollar cost average down, improve my risk reward. So, all right. So just in case we haven't talked about this in a while, so my target's going to be 70% of max gain, not 100%, not 50%. Stop is going to be fixed 50% of max loss. So max loss will be the entire amount you paid for the position. Max gain is going to be the difference in that and $10 because we're at 80 and 70. It's a $10 spread. 70% of that difference. Okay, so we don't intend to keep the spread past DTE 21, which is 21 days to expiration. All right. Okay, so then in the I'm going to move this pane off here in a second, but I have this position management parameters. This is what I'm going to plop into my little trading view jig, and it is going to put this here. It is going to print where my stops and targets are going to be. If you haven't seen that, I'll walk all the way through. So I've got it right here. There's my time price line, profit entry. First of all, we're going to get today's date, which is 23rd. Let's do it tomorrow. And then the profit at entry is going to be about 86. Stop is going to be 63. Exit, we're doing 227, going to be 227, somewhere in there. And our exit price is going to be 79.50. And our stop is going to be 69.70. Okay. All right, put a... Now right off the print here, let's get rid of some clutter. Right off the bat, we look like this might just be too short. Let's put some vertical lines in. So our 21 DTE line is right there. Our expiration line is going to be 320. March. Put it right there. That's the Monday after. So I'll color it red. And we'll make it green. Sure. Okay, so let's see what we got here. Break even is going to be 73-ish. Right at that point, we can put our break even line right about there. Okay. Then it's pretty simple. You draw a line to that break even. That's going to be your break even trend line. So if you don't know, options are option price is highly dependent on time. And so when you throw time into the equation, you do not have support and resistance lines like you would normally have on a trade. You have these target and stop surfaces. So if you imagine this thing, I guess in some ways might make more sense in 3 dimensions if we included like volatility and time as a dimension. But just to keep it simple, we've got these surfaces, and we're looking at kind of like the side of a surface, all right, and stops and targets. I'm trying to do here with these simple derivatives is just take a rather complex offering and make it into really simple, actionable, executable framework. So I'm drawing here. This is going to be my that's going to be my red zone. So I'm in the red in the trade, and my stop loss is going to be at the bottom. Now, of course, hopefully you guys know that you can set any trend line. You can set an alert and a note for the future. This is going to be stop, hit. I don't normally put these in until I've actually, gotten filled in the trade, but I'm going to go ahead and just demo the whole deal. And I'm going to use another little polygon here just to make it easy. And then I'm going to draw this up, and we're going to take a step back, and we're going to kind of look at how our trade, this polygon represents our trade plan parameters, which are, I have A back tested them. B, they are kind of common set of parameters that are used by spread traders. So, we're going to take a step back here, and we're going to look just overall at the symmetry of this particular setup. And there's some things I like, and there's some things I don't like. I think so if this guy shoots up rather vertically, the way that we did the last time, I don't know, 20 years ago, we're going to be rolling him, and we're going to be rolling him at around $80 and get the next one and the next one. And in fact, let's see if I still have it. That's kind of what we did with Newmont. I took Newmont down around in here, and we took a dip, and then I rolled it 3 times, and I still got a few contracts on. We haven't quite gotten out there at the top. But I'm going to just let these contracts ride. You can see how much time I have on them. Up here still looks good. The spread's working in my favor because I'm in the money on the time component. It can go straight sideways and I get max gain. So that is beyond the point, well beyond the point of any concern. So over here, I think my concerns to start with are that there's not enough time, even though it's 150 days. Looking at the weekly chart, I might come issue an alert tomorrow that's out in where this green line is probably out this way, and then I'm starting to see this polygon will flatten out and it'll kind of follow the broader trend line that we sort of held up there. It's always nice to see sort of the trend lines and the moving averages line up together, so that you have like a floor underneath the trade. And let's see, a couple other things. So we do have a little head and shoulders down here, right there. It's got a little bit of juice left. That could run out. If we look at kind of our liquidity pools, we're up here in sort of a seller's pool, so we might need to exhaust those sellers before we go higher. So I might not put this in tomorrow. I might just kind of be patient with it and just kind of see how the intersection of liquidity and the short-term price action doesn't improve. If we go back to our board here, I mean, it really depends on, let me select, this change. So, if I can get like gamma exposure here, if I can get kind of a big tick up in this 85 or 90 while there's liquidity, then I might consider a 75.90 and see what that does. If we were to let's just do that and see how it looks from see how wide. So now we have 30 cents in the bid ask. That's not great. It's not great, but get 320. Now we have a 15 spread. The risk reward's a lot higher because we're out of the money on the long guy, and our theta is not costing us. It's a bit more expensive. It's like about $1 a day, but I don't like that the Black-Scholes price is printing lower than that. So actually, why is it? Oh, I'm sorry. I've made a mistake. Now this is actually quite a lot. So I have an override cell. Don't want to do that. So now actually this looks pretty good. So we got a bid and ask of actually 10 cents somehow. So this will probably get filled with 235 versus 275. This is actually much more attractive, especially if you expect kind of the breakout. Let's see. This is just shopping like you do for anything consumer electronics or whatever you're going to do. Just shopping. I really like that. I wonder if we can get, I mean, this is too wide. It's a very wide. So I wonder if we get liquidity, because this implied vol is reading off the bid and not the ask. So, I wonder if we can get liquidity down here a little further out. No, that's no good. We could go to the end of the year. So at 238. Name of the game is liquidity. There's 15. That's also very high. The risk reward on the 75. These are way too wide. Let's see, what is 85? That's better. We've got, so, kind of wait till the market print liquidity and see. This is way out there. TBD on that. But this is, when I do issue these, paid members, I do quite a bit of shopping, and I get the most optimal spread on the board. This is, if I can get something like this kind of volatility spread, which is not accurate because of the ask is so much higher than the bid. If I get this kind of volatility spread, it's a no-brainer. I mean, look at that. It's like, you're never going to get this 153 versus $3. So that this number right here is not correct. Number should be about 4. So we'll see. I mean, like, let's call this. Let's say we got 275. What is this? This is a $10. We got 275. That one's okay. I mean, 250 would be even. Yeah. So now I'm getting like a 4 risk to reward. The leverage looks right. So we'll just have to see. I'd say as I sit here, I probably want this to look something like that. Just the shape of it, right? A little further out there. So, all right, feel free to let me know what you guys think. All right, feel free to let me know what you guys think. That's all for now. See you in the next video.